3 months after a bold pivot. The runway's half gone, and the bank is asking for revenue that doesn't exist yet.
Welcome to Capital Conversations. I'm Glen Gould. Today, I'll walk you through a practical, lender-ready playbook to bridge capital during a transition without handing away control. Picture Maya. Small SaaS, steady monthly revenue, but customers kept asking for usage-based billing and a new feature set. She pulled the team to pivot. 3 months later, development is underway, churn is down, but cash is tight. The board liked the vision, but lenders asked for ARR that hadn't materialized. Maya faced 2 bad choices: expensive debt with a cliff, or equity that diluted control. Curious. So how do I know this isn't just wishful thinking?
Good question. You answer it with evidence, not optimism. A 1-page pivot narrative, a 3-scenario cash model, and at least 1 anchor: a pilot, PO, or deposit. That's what turns hope into fundable risk.
Not all pivots are the same, and lenders don't treat them the same.
There are 3 practical buckets: product pivots, market pivots, and revenue model pivots. Each changes timing and predictability of cash, which is the lender's core concern.
Right.
So how do you bridge that timing gap? Start with non-dilutive options. Customer pre-sales and deposits, easy to sell if you give customers real value up front, vendor payment terms, and receivables factoring. These shave runway needs without giving away equity.
Here's an immediate deposit pitch you can use. Pay $10,000 now, secure early bird pricing, and get implementation in 60 days. Short, concrete, and tied to delivery.
Next tier, revenue-based financing, if you can point to historical revenue or an anchor customer. It repays as a % of top line until a capped multiple is met. No equity, but make the percentage and cap sensible.
Then consider convertible bridge notes, but structure them with milestones and short conversion windows so you don't invite open-ended dilution. If debt is required, prefer short-term loans with contingency-focused covenants, not strangling fixed amortization.
Now the playbook, step by step. Step 1, size the gap precisely. Build a 3-scenario cash model, conservative, base, upside, for the next 6 to 12 months. Show runway with the pivot and without it. Be explicit about payroll, development, marketing tests, and a contingency buffer.
Step 2. Create that 1-page pivot narrative. Before and after financials, unit economics for the new model, expected payback period, and sensitivity to slower adoption. Include a pilot agreement or anchor customer if you have one.
If I'm reviewing this, what convinces me most? Signed commitments, a PO, a deposit, or a pilot with measurable metrics. Numbers beat promises every time. Step 3. If you take equity, make it milestone-based. Example terms: 6 to 9 month term, conversion only if revenue reaches X or a priced round closes, a clear cap and discount, and short conversion window. Add a modest interest or priority repayment to balance investor risk.
Step 4. Design repayment to scale with outcomes. For revenue-based deals, tie repayment percentage to top line and let the % step down as revenue exceeds plan. For loans, negotiate milestone-based amortization instead of a fixed monthly payment that could choke you.
Step 5. Offer credible downside protections. Staged disbursements, conservative covenants focused on reporting rather than control, and non-core assets or escrowed revenue as backstops instead of blanket personal guarantees.
Mini case 1. SaaS moving from flat fee to usage billing. Stack, small revenue-based advance tied to historical ARR, plus 2 pilot pre-sales to validate usage. Pros, limited dilution. Cons, needs telemetry and enforceable usage measurement. Mini case 2. Hardware retooling for a new vertical. Stack, vendor terms and deposit pre-sales, plus a short equipment loan. Pros, preserves equity. Cons, depends on pilot momentum and deposit timing. Mini case 3. Services to subscription. Stack, invoice factoring to smooth cash flow,
and a milestone-based convertible for strategic hires. Pros: immediate runway. Cons: factoring costs and milestone risk.
When you sit across a lender or angel, lead with the problem and the evidence. We're shifting pricing to improve LTV by X% while keeping CAC constant. Here's a pilot agreement and a conservative cash model showing a 3-month delta of $120,000. We're requesting a $100,000 bridge with staged disbursements tied to milestone A and B.
And the top objections?
They'll say, not enough traction, projections are optimistic, or you lack covenants. Answer with one line plus a document. We validated with pilot contracts attached, and we modeled a worst case that keeps 3 months of runway. Then show the sensitivity table. Documentation lenders and angels want: a 1-page pivot narrative, a 3-scenario cash model, customer letters or POs, updated CAC and LTV, and a hire/timing plan. Include a sensitivity table. It proves you stress-tested the plan.
Here's a 1-page mental checklist you can use this week. Quantify the cash gap with conservative scenarios. Secure at least one anchor, pre-sale, PO, pilot. Prioritize non-dilutive capital first. If taking equity, make conversion milestone-based and time-limited. Offer staged disbursements and focused covenants. Track 3 headline metrics: runway in months, conversion rate to the new model, and payback period for new customer acquisition.
3 actions to take right now. Draft that 1-page pivot narrative and share it with your CFO or advisor. Call your top 3 customers and test a deposit-based pilot. And prepare a milestone-based convertible term sheet draft to show investors. Do these and your negotiating leverage shifts immediately.
To recap, diagnose the pivot type, size the gap with conservative scenarios, prioritize non-dilutive bridges, and if you take equity or debt, structure milestones, stage disbursements, and protections that preserve control. This framework is repeatable across product, market, or revenue pivots.
If this episode helped, subscribe to Capital Conversations so you don't miss future playbooks and founder-focused funding strategies. Share it with a founder about to pivot. It might be the bridge they need.
Keep building. Let's talk capital. Until our next conversation. Thank you for joining us on Capital Conversations. I hope today's discussion provided valuable insights for your funding journey. Remember, securing the right capital is a crucial step in building a successful business.